Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's May 3rd, 2019, episode 26. I'm Patrick Ceresna.
And I'm Kevin Muir. Thanks for joining us this week.
Now, this show is broadcast as both a podcast and a video on YouTube. So if you're enjoying this as a podcast and you feel like you're missing out on the charts and videos we're referencing, you can register at the markethuddle.com website and get the weekly email, which includes the chart pack and video links, or just flip over to YouTube.
So, Patrick, I actually got the Market Huddle segments going.
Nice.
Believe it or not. So now if people don't want to listen to all the Market Huddle in its entirety, which sometimes runs much too long, they can go to Market Huddle segments and they can get the individual segments so that there's you can listen to the guests, which I completely understand if you only want to listen to our guests and don't listen to Patrick and I. As I mentioned last week, we weren't prepared to cut it down because this is our night out drinking. We've convinced our wives that this is an important kind of market event. And we're not going to cut it down, but we are going to divide it up. So go to Market Huddle segments and get the different pieces if you want.
Or you can listen to the main show, though.
Sorry.
But people can still get the main full show.
Oh, yeah, for sure. Don't worry about that. The main show, for those diehards, don't worry about that. The main show is still there. It's just there's now something Market Huddle segments for the different pieces. Okay, on to this week's episode. We're joined by Aidan Garrib from Pavilion Global Markets, and in our This Week in Trading History, we remember back to the days of barbarians at the gate.
We're also joined by Neil Hunt to talk about the Eurodollar markets, and for our WTF video, we're wondering what's going on in Cramer's head. And finally, we're going to talk about the top 5 most important things to watch next week. So let's jump right into it. So who is the show brought to us by this week?
It's brought to us by Flying Monkeys. And the beer is 12 Minutes to Destiny. Well,
I love the name, by the way.
And they've asked me to read a little bit, kind of the promotional point here. And so let me do this. Every now and then you should sit and enjoy a beer. Unless you feel you're too busy, then you should definitely have 2. This sessionable, again, the sessionable ruby tinge brew is perfect for stopping the day and breathing. So, Patrick, let's stop the day and breathe.
All right.
Okay. 1 second. I got to give you a little heads up, Patrick, before you taste it. There's hints of fresh raspberry.
Oh, my God. Yeah, I was about to say, this is like an explosion of fruit in your mouth. I mean, it's actually smooth. I mean, it feels like actually you're drinking like club soda with some fruit in it. It doesn't actually have a real strong beer taste at all. Like, this is something that this is a summer drink where you could be like out on the dock and in the hot sun. And I'm not going to say anymore.
Let me do my legal stuff before we get in trouble with the sponsor again. Okay, clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com. Side effects of too much Market Huddle may include space rabies, synaptic seepage, and this is my favorite, and or spontaneous loss of bladder function, more commonly known as the Huddle Puddle.
Oh, I've suffered from that before.
Something that happens in later age. Once you get over 40, you get more Huddle Puddles.
No. Right. Anyway, so let's move on. So we always invite a guest on to talk about the most important event of the week. And this week we're joined by Aidan Garrib. How's it going, Aidan?
Pretty well, guys. Although I'm not drinking a summery beer right now, but I will be very soon.
Oh, nice. Well, Aidan, you prepared a fun chart deck to talk to us about China. So I'm looking forward to jumping right into this. So, what's on your mind on China here, and what are we looking at here? Let me just launch this into.
Well, I think
screen.
there's a number of themes right now that are driving markets at the moment, and from my perspective, China seems to be the most misunderstood. So I really want to explain my thoughts on what's going on in China and then discuss the implications that this has for markets going forward. So here on page 2, what you can see is Chinese producer prices and U.S. core PCE, so the Fed's preferred measure of inflation. And so Chinese PPI tends to lead U.S. core inflation by about 12 months. And this shouldn't be a surprise to anyone who's ever walked into a Walmart and picked up anything and it says made in China on it, right? So as this disinflationary pressure has mounted over the last year, the Fed's become dovish. And we think they did so not just because of the impact on U.S. inflation, but also because China's options are becoming increasingly limited. And a wrong policy move on behalf of the Chinese, or on behalf of the Fed for that matter, could actually destabilize the global economy, which is something I'll try to clarify in the coming slides. But I've just been struck that this hasn't really been something that many people have spoken about. And so that's the reason I really want to get into it with you guys today. So on page 3, and by the way, feel free to jump in at any point, ask questions, call me an idiot, yell at me and tell me I'm wrong.
We don't do that to guests. We just do that to each other, Aidan. Like, we have a strict rule. You're not allowed to call the guest an idiot, but Patrick and I are allowed to call each other idiots, and you're allowed to call us an idiot.
Okay, right. Sounds good. Yeah. I like the asymmetry in that trade.
So what we have, by the way, so what we're showing here is the Chinese. Do you, on this chart though, before we move on to chart 3, do you believe that this is a turn point in Chinese PPI, or do you still think that this is heading lower?
I think we've seen a bounce, but by and large, I think it's heading lower, and that's really what I'm going to get into, which is this misconception where I think the market is looking for, this stabilization or recovery in China. And they may stabilize, but it's going to be at a much, much lower level than I think the market is prepared for based on market action.
So this chart going lower implies that you think that there will be less inflation or disinflationary pressures in the U.S. Is that fair to say?
Yeah, that's exactly it.
I love this guy, Kevin. I love this guy.
Of course, Patrick is all over that. He's going to love this. Okay, so let's go to the next chart. Let's see why.
All right, so on page, I guess we're on slide, so on slide 2 now, you can see the eminence, I guess, of this disinflationary pressure. And it really started with this buildup that we've seen, overcapacity buildup in China over the last, 20 years. And we've seen this brief kind of bounce, but overall, you look at the industrials and you look at the metals complex, and that seems to be rolling over again. So I think China is really in this tough spot here. Now, why do I think that this is going to fade? So go on to the next slide, and I think this is really where you start to see the problems emanate, which is the credit space in China. So this chart, I guess it's a little bit complex. You have the reserve requirement ratios for the banks. So that's just the amount of money that the banks have to set aside and what they can lend. And so you've had this massive slowdown in Chinese growth, but they haven't really pushed major stimulative policy. In fact, I would characterize the Chinese policy response as somewhat underwhelming. They've cut these triple Rs, but you're seeing here that it hasn't spurred much credit growth. And in my view, this is because China faces this impossible trinity, which is brought up often, but I think it's quite important in this context. So what does that mean? Well, economic theory would tell you that you can't have a stable exchange rate, an open capital account, and independent monetary policy all at the same time. So if they cut interest rates, there'd be some capital outflows and the currency would weaken. So let's kind of unpack this in turn. So the RMB, the renminbi, it's a pegged currency, right? It trades within a narrow range And the easiest way for China to boost growth again would be just to flat out come out and devalue the currency. But they can't, nor do I think they really want to, which is something I'll cover. But, with this trade war going on, you have Trump that's coming out and saying, warning them not to devalue. You have Mnuchin coming out and saying, we're watching the currency, don't devalue. So China can't devalue, so the currency's pegged. Well, what about the capital account? Well, ostensibly, China has a closed capital account, but really, they just crack down on capital outflows. North Korea really has a closed capital account. And if you doubt the openness of China's capital account, then I invite you to come to Canada. Well, you guys are in Toronto already. So, go to Vancouver, go to Toronto, and look at the real estate prices there, right? Look at the fake import invoices. So China does have a pegged currency, and it de facto has an open capital account. So that must mean that they import U.S. monetary policy. And that's too tight for China. That's why they're resorting to these RRR cuts, and that's why it's ineffective. So let's drill down to this in a little bit more detail, because I think here's where it gets more interesting. So Patrick, please go to the next slide.
Right.
So this is China's credit puzzle. So the problem for China is they developed under a dollarized financial system, right? In an ideal world, or if you look back historically, China exports stuff and get dollars. Those dollars get converted to RMB. Some of that sits as reserves in the bank sector, and some of that gets lent out. We'll take a look at what's happening here. The PBOC, or the Chinese Central Bank's balance sheet. Their assets are declining, and more importantly, foreign assets, i.e. dollars, are declining. So that means that by the transitive properties of accounting, that means that central bank liabilities must be declining too. That is what we see. And in fact, look at the portion of liabilities that are contracting the fastest. It is these commercial bank deposits with the PBOC. This is the definition of money. So money in China is contracting at 12% year on year. This is the epitome of disinflation. This is really the problem in China. As they bleed dollars, they have less dollars to back the currency. So the actual credit growth that they can generate becomes increasingly limited. Now, you guys might say, well, hold on a minute, Aidan, you're an idiot here. I've looked at, the news over the last few months, and I've heard there was a resurgence in Chinese credit growth.
I was about to ask you that, Aidan, because no, it's not. I wasn't going to call you an idiot part, but it was the part where there's this big surge in the credit and the social financing in China. Is that the response mechanism to the fact that they're experiencing this? Is that linked to the fact that they're trying to stem this bleeding and kind of rebound this, or am I not connecting the dots properly?
Yeah, so they're trying. And so what they're doing right now is they've actually imposed some tougher capital controls on commercial banks' deposits offshore. So because China has this Belt and Road Initiative, there's RMB sitting offshore in, for example, Bank of China's accounts in Mongolia or whatever. And they've effectively just stopped that from being lent out. And they're using that, it appears, to try to spur credit, along with some of the inflows into Chinese equity markets and some other ways that we'll get into. But if we dig into the next slide, I'll show you the credit growth story, both the formal and so on this slide here, it's formal credit growth, so, typical banking sector credit, the shadow credit, and then something called SOE, or state-owned enterprise fixed asset investment. So let's look at these all in turn. So at the beginning of this year, there are these calls of, formal bank sector credit is growing quickly again. China's coming back. Well, actually, when you look at the formal banking sector credit, it just reflects more of kind of the cyclical trend that you tend to see in China, which will become apparent later on. But it doesn't really seem like there's that much of an extra boost here. Where we are, the lines that I would focus on are the ones at the bottom, the light blue and the red, which is the shadow banking credit and the state-owned investment. So the fixed asset investment, the roads, the bridges, the highways to nowhere, all that stuff that we've come to know and love from China. So what you can see on this chart is post-GFC, China saved the world, right? There was a massive expansion in credit from the formal banking sector, which spurred growth. Since then, it's been shadow credit. So we saw in 2013, 2014, and again in 2016, this shadow credit that drove growth, and in doing so helped reinvigorate and reinflate the global economy. Now, the formal credit we've heard so much about since the beginning of the year, it's basically just used to roll over existing loans. And I think you see this on the next slide quite clearly. So this slide shows you two things. It's the ratio of short-term to medium and long-term bank loans in China. So one to households and the other to non-financial corporates. And so increasingly what you see here is that the short-term loans become an increasing proportion of total loans. And this seems to increase every year because the banks are apprehensive to lend within this slowdown. So at the end of every year, loans come due, both short-term and long-term loans, and then they tend to refinance most of that with new short-term loans. So that's why you're seeing this kind of cyclical pickup in Chinese formal banking credit. It's nothing more than just short-term loans coming up for renewal because banks don't really want to extend credit. So why does all of this mean that China can't stimulate enough now, and why does it matter for global growth? Because I think that's kind of the key question here. So if you go to the next slide, I'll show you once again, this is the fixed asset investment in China, which again drove growth post-GFC, again in 2013 when global growth was slowing, and then again in 2015, 2016 when global growth slowed. So can China do it again? One more turn. Go to the next slide in this deck. Look at why I think they can't really do it. So this is M1 growth in China. If following the financial crisis in 2010, money supply, so M1 grew at 40% year on year. In 2013, it grew at another 15%, and in 2016, it grew by another 25%. So can China do that now? Well, M1 in China is 256% of GDP, and investment is less accretive to growth than it was in the past. So sure, they could try to boost the money supply by another 40%, but I don't really think they could do so. The reason is on the next chart, you see kind of the hamstrings to Chinese money supply, which is, again, China has been a dollarized financial system. Well, China's not seeing inflows from the current account, and the central government is running a budget deficit, to say nothing of the local government. So China's already kind of burning through all this cash. It's one thing to spur more credit growth if you were getting U.S. dollars in, but they're not anymore. They're actually burning through this, and you can see the reserves. That red line at the bottom it has turned negative. So I guess they could turn on the printing press, but that would cause massive devaluation in the RMB. And it would effectively risk $1.6 trillion of debt defaults in EM Asia, which I'll get to in a minute. So you might say, well, okay, but the Chinese data is saying something, and you're saying something else. So, can you corroborate your view, or do I just believe the Chinese data? Well, let's see where we can corroborate the Chinese data. If you go to the next slide. So these are the countries that typically export to China, right? You have Taiwan, Australia, Korea, Japan, Brazil ships them iron ore. Well, look at what you're seeing here. By and large, you're seeing exports contract at, between 2.5% and 20% year on year, with the exception of Australia. Well, let's look at export trade by volumes. So if you go to the next page, look at export volumes, right? Broken down by EM region. They're all sharply following. In fact, that second derivative, that line's, looking like a steeper and steeper fall. Now, right. Let's look at one other place to corroborate it on the next page. So this is, Germany. So Germany is an industrial powerhouse. They export a lot to China. Look at what we saw there. This is an interesting chart because it's German industrial and manufacturing orders in volume terms. And the German data, like everything else out of Germany, is pretty good. You get it monthly. So look what we saw. Chinese PMIs picked up in early 2019. We did see an increase in this German industrial activity then, but since then, it's started to fade. It's really started to roll off. So it just looks like a sharp bounce. and it doesn't look like it's going to be sustained. And so here's where things actually get much more interesting for China, is on the next page. So this is Chinese export volumes, right? And global trade volumes. So look at what Chinese exports are doing right now. They're contracting at 4.1% year on year, far sharper than the slowdown that we're seeing in global trade. Well, the last time that Chinese exports were contracting by this much was in 2015. What happened in 2015? We woke up one day to find out that Chinese policymakers had decided to devalue the currency, right? Well, one part of me says they would like to do so again. The problem is that, as I had alluded to earlier on, is there's about $1.6 trillion of dollar-denominated non-financial corporate debt in EM Asia, right? So again, to say that again, non-financial corporate debt denominated in dollars in EM Asia is $1.6 trillion. About 50% of that sits in China. So if China devalues the currency, they risk spurring 800 billion of defaults among their corporates. Worse is the fact that the rest of EM Asia, which actually exports to or competes with China for export market share, they're forced to then devalue, and then that risks spurring the other 800 billion worth of defaults there. So I think China is sort of hamstrung here in the fact that they can't really devalue, and the Fed, I think, sees this, and that's why they've become somewhat easier. Now, one thing that's even more interesting than this is I don't actually think China wants to devalue. And if you go to the next page, I think this is maybe a chart that shows you why I don't think they want to devalue. So here's some of what I call the practical limits to China's devaluation. So these are commodity prices priced in CNY, right? Chinese currency. And these are the commodities that matter most to China. So in 2015, when China devalued the currency, they were able to reinvigorate exports, right? Well, it was kind of a Goldilocks situation for China back then, because look at that dark blue line, which is oil. So although China devalued the currency, oil denominated in RMB was actually falling much faster. So it was a great Goldilocks situation for China because they devalued, their exports became more competitive, but oil fell faster in RMB, and so it didn't lead to any kind of PPI increase or it didn't cause any strains. Now what we're seeing is the commodities that China relies on the most for industrial growth, they're actually increasing in CNY terms. So if China devalues, it hurts them even worse. Yeah.
All right, so Aidan, now what if, like, as we just saw a pretty notable 1-2 day drop in copper prices, even oil seems to be, at least in the last few days, coming off its peak highs. By no means am I trying to already suggest they're in a downtrend. It takes more than a few days to put something in motion. But would your narrative change if commodity prices demonstrate in the coming month that they've reached some sort of intermediate highs and that they may actually start to weaken? Because if that scenario, now I'm not trying to make that as a prediction, but what if that was something that was to develop? Could that change your view that China may be more inclined to move their peg?
To devalue. I think it would be tougher for them, right? The reason I say that is, and this is a good question, the reason I think it would be very tough for China to devalue the currency is because of that green line there, right? Which is gold priced in CNY, which has been stable compared to all the other currencies. Now,
right.
If you are Saudi Arabia or you are Brazil, so China's not just trying to denominate more of its commodity purchases in its own currency, right? Because once it does, it wins, right? Just like the U.S. has been able to denominate trade in its currency, and it's, there's a benefit that's accrued to it as the global reserve currency as a result of that. Well, if you're Brazil or you're Saudi Arabia, you don't need to hold RMB, right? Global trade's denominated in dollars, and to the extent that you have foreign currency debt, that's probably denominated in dollars too. So, sure, China may arm twist you into selling oil to them under their RMB futures, denominated futures. But once you sell them the oil or whatever the commodity is and get RMB, your best interests are effectively, dump the RMB for dollars. So why would you hold RMB? Well, you'll hold it if it's as good as gold, which so far it has been. Now, the problem then is for China, if they devalue the currency and gold starts to fall in their own currency terms, then, what's the incentive for these countries to really hold RMB? And it sets back, in my view, China's aspiration of being able to denominate more of the commodities that they need in their own currency.
Right. And now I've heard though from really smart people like Russell Napier, who make the argument that because of the situation with China's current account, that they themselves it's untenable for them to actually maintain the currency at these levels. And at least Russell Napier speculated they might actually just float the renminbi as because it's not tenable for them to drop it, because it's just too much political pressure from U.S. Under those circumstances. What do you think of a story like that? Is that just, in your mind, nonsense, or is there something behind that?
No, I think there's something to that, and I think that is what will eventually happen. But I think before that happens, what China needs to do is take more concrete steps to clean up its banking sector, clean up the debt. Because if you just devalue the currency, then again, the risk of default just becomes too great, and that sets your economy back even further. So I definitely agree with Russell Napier and others who say, look, the path of least resistance on the currency is downwards. And in fact, that's why China has capital controls, right? It's to stem downward pressure on the currency. I just don't think that they can do so until they finish, getting their credit house in order, so to speak, and cleaning up the NPLs and the debt and recapitalizing the banks. And that's what they've actually been trying to do. And so my view on this is that, look, it looks like we're going to so the BOJ still is doing QE. It looks like they're going to continue to do that forever. The ECB looks like they're going to have to go back to QE as well. And the Fed has gone from, talking about the balance sheet reduction being on autopilot and hiking to now saying that, the balance sheet is going to stay stable. And I think they're actually going to have to expand the size of the balance sheet sooner rather than later. And then I think China can come in and take some steps to do some QE. And look, China already has put in place like a bad bank to effectively take some of these bad loans out of the formal banking sector and recapitalize them. And so once they do that, I think they can devalue, but I don't think they can devalue. I don't think they can devalue in the interim before they do that. So
now there's we're approaching halfway mark of 2019. Do you think that that something in China plays out in this calendar year, or do you think this is more of a 2020 story?
Well, I think the thing to watch first is watch the Fed, right? Because we're seeing this, tightness of dollar liquidity that's really been impacting China and other EMs. And I think as you see the Fed become more dovish, which is kind of my base case, is they go back to expanding the size of the balance sheet, then you can get China make these moves. But I don't think it will happen before the Fed. So my view is the Fed does it sooner rather than later, and then the Chinese will follow suit shortly thereafter.
So it's Kevin here. I'm just going to jump in. So, sure. Aidan, so you think that the Chinese are hamstrung in terms of devaluing because of their own internal issues and not because of external political issues, put on them by Trump?
Again, there's both. So I'd mentioned that, they can't devalue. So they can't devalue because of some of the debt reasons, but then they also can't devalue because then that makes the trade war more acute, right? Because Trump has said not to devalue. Mnuchin said we're watching the currency. So I don't think they can devalue without making the trade war more acute. So there's both internal and external reasons that hamstring them from doing so.
You've just one second. I'm going to keep going, Patrick. So you've kind of posed quite the big kind of pile up in front of the goalie here in terms of all the problems that China is facing. Do you think that they're going to be able to stick handle through and put the puck in the net? Like, are they going to figure out a way around this, or do you foresee this kind of erring much more on the side that eventually China is going to run into some troubles, and that the next crisis is coming out of China?
Yeah. So, I mean, if you, all the other, all the capitalist countries have run into recessions. They've been trying to figure out their way around this. So can China do it without, can China find success where the others have failed? Maybe. My view is that they're, rushing to put in place these policies to make sure that a crisis doesn't occur, right? So they've started the bad bank that's trying to take these bad loans, and they're trying to clean up the financial sector so they can eventually devalue. The question is, like, where does the blow up come from first? I actually think it probably comes from outside of China. In my view, it'll probably come from from some of the high yield sectors in the U.S., the CLO market. You're likely to see some risks there. China, I think you're
How about
seeing
the emerging markets? Do you think some other of the emerging market players could be problematic in that, or even Europe? Like you think it's just high yield in the U.S. that could do it? Like where's your kind of problematic areas around the world that you think some of this crisis could develop?
Yeah, well, you're seeing it in EMs right now, right? In Turkey and in Argentina. And it's actually funny because, look, when we had the strong dollar last June, it's the same thing, right? You saw the blow-ups in the weakest emerging markets first. So I think that's more or less what you're seeing play out right now. If there was to be something acute outside of the kind of CLO market in the U.S., I think it would come from emerging markets who finance themselves in dollars, because dollar liquidity is getting tighter, and if the Fed doesn't kind of turn dovish sooner rather than later, these EMs are really going to start coming under strain. So it's not just Turkey or China, but you're also starting to see some pressure in places like South Africa as well. Korean exports are falling. So it's the broader EM complex, I think, is vulnerable.
So Aidan, Kevin here again. So Aidan, you've given us quite a lot to think about in terms of this. This chart pack is just outstanding, and I feel like I should stop drinking beer and focus on the charts. No, drink
more beer.
I was sitting there, I was like, oh my goodness, better. This is actually, I got to think, what's he doing to me? I just kind of, I've been probably on the other side of your trade in terms of, I've always contended that China is not going to be as bad as everyone thinks. But you've definitely piqued my interest, and I'm, great trader always stays open-minded. And at the beginning,
I personally think his
of course
ideas are brilliant.
But listen, I just want to finish up with one last thing. So you mentioned that you thought that the market wasn't appreciating your view, and you went through and you articulated very eloquently why this was the case. If this is the case, and the market isn't appreciating this view, what do you think the best kind of portfolio moves are, or at the very least, what do you think people should look at in terms of? Because I believe that it's what's that old Mark Twain, or actually might not even be Mark Twain. That old expression is not what you know that gets you in trouble. It's not what you think you know that gets you in trouble, or something to the effect that it's what you know for sure that just ain't so. What do you think the market thinks it knows for sure that just ain't so, and how do you take advantage of that in China?
Well, if you look at, for example, look at the copper to gold ratio, and then look at MSCI EM, or look at Chinese equities, there's been this huge disconnect where the market's expecting profitability to come back to Chinese firms, right? And that hasn't been the case. Where we have seen profits over the last few months has largely been in the upstream state-owned enterprise sector. And that really just has to do with the fact that there was a rush of demand for firms lower, or I guess more downstream, to buy goods from them ahead of the VAT reduction, because they could claim that back on they could get a tax deduction for that. I see this disconnect when I look at the massive run-up you've had in these Chinese equities since the beginning of the year. But to the traditional metrics that you'd like to see accompany a rally in Chinese equities or EM equities, like commodity prices, just hasn't been there, right? Right. Something else I would look at is FX reserve growth among EMs. It's it's contracting, right? So as EM trade just continues to slow, I think these are kind of the signs that things are not improving. So the way I look at it is I say, okay, we've seen this little bit of a comeback of some of the cyclical stocks and some of the EM stocks. How I would want to be positioned for this is I would look to fade it and think, okay, well, the central banks are going to try to come back to the rescue. If the U.S. can avoid a recession, which I think they can, although growth may slow there, then I want to kind of be barbelled in some of the quality tech names, some of the defensive sectors in the U.S. economy, and then some of the sectors that are exposed to lower yields, like there's some areas of the housing market I would like, not the home builders, but lumber firms, for example, because I'm assuming, look, rates are going to come back down, and long duration is going to do well. The growth stocks or pockets of the growth
to my
stocks
ears. This
are
is
going to do
beautiful.
okay. Well, it's if the banks go back to stimulative policy, which increasingly it looks like they're going to be forced to do. What's going to benefit from that?
Okay, so Aidan, it was fantastic. I sat here mesmerized, like seriously, like this chart pack that you put together was fantastic. I just want to let everybody know, make sure you sign up for the Market Huddle weekly chart kind of email, because Aidan was kind enough to include his full kind of 50-page chart pack, and it will also include these last 10, 20 slides that he's gone through here. Before we let you go, Aidan, why don't you tell us a little bit about where people can find you, what your firm does, and where people can reach out to kind of learn more about you?
Sure, yes. So I'm head of global macro strategy and research at Pavilion Global Markets. We are an agency-only broker out of Montreal, Canada. We run a 24-hour trading desk here. Global equities on an agency-only best execution basis. We don't trade against you. We don't take any prop risk. We don't sell your flow. And so, I run the global macro shop here, which effectively tries to put out actionable trade ideas for institutional clients. And we have a high value-added trading service that comes along with that. On the front of the chart deck is my email, so feel free to email me at agarrib@paviliongm.com. You can see it there. You can also follow me on Twitter. My handle is @Aidan Garrib, all one word. I tend to share a lot, and I don't really post much original stuff on there yet, as I'm trying to work through some compliance related issues with respect to what's free speech and what the regulators can ding you for. But you can definitely hit me up by email, and I respond pretty well to DMs on
Well, that's
Twitter.
terrific. So for everybody else,
perfect.
make sure you stick around, because Aidan's going to stick around as well, and we're going to have a terrific after-hours section where we talk about the U.S. dollar and go through many more of his 50-page chart deck and talk about what he foresees in the macro world and what trades you can put on. So thanks again, Aidan. It was great having you on.
My pleasure.
So joining us next is Neil Hunt, who's a Eurodollar options trader out in Chicago. And Neil was nice enough to email me some of the observations he was making in the Eurodollar options market. And I was just amazed by some of the stuff he was observing. And I thought it would be amazing to bring him on to the show. So welcome, Neil.
Hey, thanks. Yeah, thanks for having me.
So, and Neil, the first thing that I want to do, because I want to get into that big whale condor trade and other things in there, but I wanted to just start off for our listeners to explain what the Eurodollar markets are, because it's not the currency we're talking about in terms of Eurodollars. Why don't we give all of our listeners just a quick rundown?
Yeah, so Eurodollar in this case, we're talking about short-term interest rates, right? So we're, so right now, today, what they do with is for 3-month LIBOR, they take, that is the London interbank offered rate, And what they do is that they take a survey of, I don't know, it's like 12 or 20 banks or something, and these are all banks that are, not in the United States. And they take a survey and they say, okay, you're going to lend to another bank for 3 months. You're going to lend $1 million. Like, what's the interest rate? And then they do that on different time frames: the overnight rate, 1 month, 3 months, 6 months, etc. And then every single day that isn't a holiday, the ICE, the International, or ICE Exchange, I don't know what it stands for, they publish these rates every morning. So today it was, today was 256, and yes, it correlates, quite strongly with, Fed funds. So, people are involved in the futures market, that are anyone that's interested in the Fed and what they're doing. People get involved in this. But yeah, as you can see here there is a little more to it than just the Fed funds rate. So the Fed funds effective rate today was 241. LIBOR was 256. So there's a 15 basis point difference there. What this chart is showing is actually slightly different. So because on this chart is actually it's a swap rate that's supposed to be forward looking to make because LIBOR itself, or Eurodollar futures, themselves are a forward-looking 3-month rate.
Wasn't
just stop me if I'm getting too.
Yeah, but Neil, wasn't it for the longest time that the TED spread was the most commonly observed way of looking at that spread? Like right now, the OIS spread is the one that is most commonly looked at. Do you know why everyone made that switch over, or am I even describing it right?
Yeah, I'm trying to think. The TED.
It's because it's Treasury. It's Kevin here. It's because it was Treasury bills against Eurodollars, and I just don't think that Treasury bills trade as much anymore. And I think that there was at one point there was a futures contract on Treasury bills, but it just didn't go, and Eurodollars replaced it. And the important thing I think that for our listeners to understand is that the Eurodollar is really U.S. short-term money that is traded offshore. So it's the rate upon which banks lend to one another overseas. Right.
Outside of the Fed
system.
system.
That ends up being the true cost of money, kind of from a short-term perspective. And the Eurodollar futures contract is a series of contracts that is basically betting on what this 3-month rate will be in the future. So so if you go and you buy December 2019 Eurodollar futures contract, you are in essence betting on what that 3-month rate will settle at, whatever the settlement date is in December. So it's almost like if that's a 9-month period till expiry, it's really like a 12-month instrument. So that's kind of the important thing to realize. It is interesting that you're pointing out the fact that it is not exactly like the Fed funds, and I think you talked about some of the reasons that why people trade Eurodollars versus Fed funds is the fact that the Eurodollar instruments are actually a lot more liquid. Are they not, Neil?
Yeah, I mean, that's true for sure. The LIBOR, one of the things, and you've been hearing more about LIBOR in the news, is because, there's like, trillions of dollars of all these, floating rate mortgages, or all these, financial instruments that are all based off of essentially this rate, this LIBOR rate. I mean, it trickles down to even, your own savings account, if you have a savings account. Of course, if your savings account at, one of the really big banks, you're still getting like 0.01%, right? But if, for instance, there's certain banks, online banks now, I know, that are paying 2.25%. So, on a savings account. So that's, and that's related to, they move that rate up when Fed hikes rates.
So the Eurodollar futures market ends up being the most liquid of kind of, if you wanted to speculate on short-term interest rate movements. This is the most liquid instrument. I think I looked at the open interest is $1.65 trillion, like trillion, like with a T, not.
Yeah, I mean It's
And,
crazy.
The biggest money market
and
in
the
the
front
world.
month, like what are the months like when I go look at the December contract? What will be on the bid and offer in terms of how many contracts?
Easily, many thousand.
Yeah, like
up.
it's like sometimes it's even 100.
It obviously goes back and forth, but 50,000 up is common, even all the way through maybe So the fronts are called the whites, the red, the 1 year out are called the red futures. So yeah, through the reds, you can even find maybe 20,000 up. Yeah, but a lot of that's algo driven. So these guys are. They're following obviously all the rules, but the way the rules are written, you're able to put a lot of size on there to get allocated. When a 10 lot trades, you get allocated your 1 lot if you have so much size on there. It's a pro rata algorithm.
Fair enough.
Right.
So
that juices the bid and offers for sure.
Okay.
And those are the current rules, but it is a point of contention amongst many people as to what is fair, right?
Yeah. So Neil,
people are going to take advantage of this.
Yeah.
Yep.
So Neil, I want to move on because I want to get back to this condor trade. So what you predominantly trade in the options markets on this, and you saw this huge whale of a trade go through, and it was I drew on the condor trade that someone put on the Eurodollar futures, but and what was fascinating about it is it was 500,000 contracts that someone put on here, and I think, correct me if I'm wrong, it was somewhere near around 4 ticks that they paid for it, correct?
Yeah, I think it was an average price, but I think 4, maybe just under 4, if I recall. Yeah. So,
and it's not that big of a payoff because the most it could pay off is 12.5 ticks. But clearly, somebody was fading the enthusiasm of lower interest rates, right?
Yeah, definitely. I mean, they started putting it on. Essentially, we had right on that chart that you're showing. There was the March. We had the March meeting, which was no one thought it could be more dovish than people were already expecting, and it was. So you had the March meeting was the first up day. I think you have your mouse on it right now, followed by an unch day, then up big. And right at the top there is where this guy started putting these on.
So he started fading it at that point. Like he thought that basically he thought that it was overdone and that it wasn't going to.
Yeah, definitely overdone. And if you're actually listening though to what the Fed is saying, they've said they're on hold now. So this is a bet that they're going to stay on hold. Now, as I was saying, because of the, this OIS spread, other things now, there's other things involved where he could miss, right? Even if they stay on hold through the end of the year, he could miss because, you have these different credit issues, funding things that can come out of nowhere, particularly, at the end of the year end, month end, quarter end, you tend to have these, funding things. So, but the one he chose would be, where LIBOR is right now. LIBOR is 256. So, right if all else being equal today, it would be going out. It would be going outward 6. All else being equal today.
So Neil, when someone puts on a huge whale trade like this, what is the tendency for them to close it out early, or is this one when you open in this kind of size, like 500,000 contracts? Is this pretty much something that this trader will hold to maturity? Like, what is their tendency when you see something like this, or am I just?
Yeah, I mean, you have guys that I think it's not necessarily only one person. Your fund, whatever. I always say guy, but it's we call it paper, right? So anybody that's not we call ourselves locals. Anyone that's not a local, you call paper, basically. So but there can be piggybackers, right? Some people, maybe one guy, your one hedge fund bought 100,000, then someone else said, yeah, man, I agree, and then they people piggyback sort of thing. So but and then each person, each would manage it their own way. But some of these bigger hedge funds, they tend to, they will not let you out. They hold it all the way.
So when it gets Kevin,
Right.
Maybe at the very end they'll they move things around. Sometimes they'll do a call spread or put spread to kind of move some strikes around, take some profits. They can, things like of that nature.
So Neil, it's Kevin here. One of the things that I noticed when I was looking at this, and I was actually talking to another Eurodollar futures kind of trader, and he was telling me that the market makers are talking about the fact that the skew is as steep as they've ever seen. And I was wondering if you wanted to comment about that. Like, do you agree with that? First of all, is the skew as steep as you've ever seen? And if so, what's driving it?
I mean, I do. I agree. It's actually it's come back some, I guess. Relatively speaking. So it's still, the call's still trading, well over the put, but it has, I would say, right in those Fed, from that March meeting, those up days, then the subsequent kind of back down days is where the skew maybe would peaked, kind of in my mind. The condor that was put on was part of that. So they, when they're trying to pick, you pick strikes, you find, you can see right in this, perfect to put this chart up now, that how the curve looks, because you can see it's almost like there's a big kink, right in that area that this guy thinks where we're going to end up, and I'm looking at the bottom right,
Right.
There.
So
Right.
So you can see it's not like a normal smile. You have it all of a sudden it's just a kink going down, and that's the kind of thing that this is why the Eurodollar option market is quite unique, because versus trading corn or something like that, where you don't it's a price, it moves up and down. You can't. LIBOR is an actual thing. It's fixed every day. So and the Fed is either going to hike or they're not, and so these things they become more binary in nature, so they're harder to model, and it's common to see crazy things like this. But yeah, in terms of
I had a look, and the December contract, the out of the money puts are trading like 11 to 12 in terms of vol implied, and I'm showing the calls,
Right.
The big out of the money calls are trading north of 20. So, we're sitting there and it's almost 10% of vol skew spread. I'm kind of I cut my teeth on index trading in terms of in stocks. So I'm used to the smile or the kind of half smile, but I'm used to it being the other way. I'm used to it being the puts more expensive. And it was kind of shocking to look at this and see how expensive the calls were. You don't think, I guess my question to you is this unique because of the fact that everyone thinks the Fed is going to cut? Like, do you think that there's something more going on that sorry, go ahead. I'll let you go.
Well, I think it's, to me, I think the fundamental kind of reason why it makes sense to have the calls over, trading over the puts right now. It's not always this way, but why right now? I mean, the real fear is to the upside. The fear is that stocks, just similarly, within the equity markets, puts are trading over, because the fear is that, it hits the fan.
Yeah, you can say it. The shit hits the fan.
And in our product, it's the same way, that they're going to have to emergency cut. They're going to have to emergency cut 50. There's some sort of terrible event, and they're going to, tomorrow they emergency cut 50. Right? I mean, it's just that upside fear that we could shock higher. Whereas, even if the next move were to be a hike, I think this, Fed in particular. Powell has made it pretty clear that he's going to telegraph it for a while in advance. I mean, we haven't had a hike or pause or anything that wasn't almost 100% priced in. The whole market knew it was coming. That's kind of how this Fed is. They don't surprise people. So the only potential surprise, the biggest surprise would be higher, and so people fear it, and so they want to own that up there is kind of the way I look at it.
Okay, so...
But yeah, what's interesting is...
Sorry, go ahead, Neil. Go ahead. I didn't mean to interrupt you.
Oh, well, I was just going to say, when I started in '06, so it's like, I'm still a youngin' for some, some say, but yeah, what I remember is people used to say, no, the skew is to the put because it just purely based on like credit risk things. So, you have had LIBOR spike out. And what's funny is people right now, that's another thing, people just completely forget about. They just don't, they're so short, sighted sometimes that, I believe in 2010 there was a Greece thing, if you're looking at just a long-term LIBOR chart, you'll see it kind of spikes out for a few weeks or so. And there's a panic, and the puts go crazy, vol goes crazy. Certainly in the 07, 08, there were various times where it spiked. So because of that, like if you have a sort of credit event, you actually, what's interesting is people are fearing the upside because of emergency cuts, but what could actually happen in the most front month is that LIBOR spikes out, and you actually go the other way. That's what's really interesting.
I completely agree, because I noticed that as well. If you go back and look through history at LIBOR, and you'll realize that at times of stress, the volatility is actually both ways because of that credit portion. And obviously, everyone remembers back in '08 that no bank wanted to lend to each other. And even though the Fed was cutting rates, the rate for LIBOR was spiking to the moon. So if you were long, Eurodollar contracts, expecting that to save you, then you were actually, it was really difficult. It didn't do that. And in fact, it ended up going the other way for periods of time. So it is actually really interesting that the market has forgotten that risk to the downside. And I didn't realize it, but I guess what you're saying is that at times it actually is priced the other way, and the skew is the other way, where the puts are actually at a higher implied volatility than the calls. Is that correct?
Yeah. Specifically the 2016 election, right? I mean, obviously that caught equity markets, that overnight move that occurred on the election, what was it, limit down and then all the way back to higher and, then exploding from there in equity terms, right? For us, it was kind of the opposite, way higher. Everyone's like, oh, okay. And then we're just start going way lower. And, the puts, I would say at that point in time, the skew went extreme the other way, and the puts were trading maybe, in just basis point terms, a couple ticks over the calls.
So 1 second.
That caught a lot of people off guard.
Sorry, I'm going to actually jump in here again. It's Kevin. So Neil, I have one last question for you in terms of this whale comes in. He wants to buy this condo, or they're gobbling up all the calls because everyone's worried about this. Who's selling it to them, and are they the weak hands, or is the buyer the weak hands? Like, I kind of wanted to understand the market positioning about like who is on the other side of that whale's trade.
Yeah, no, it's a good question, because I ask myself a lot all the time. I mean, the way everyone trades differently, but kind of, I am a market maker, but the way I look at things, I try to, part of the reason I'm a fan of you guys is that, I try to keep a more macro view. But yeah, who's on the other side? Mostly, there's a lot of locals and, big firms, market making firms that are willing to take down,
that sort of size,
a lot of size, basically. So they are on the other side, and then their strategy is that through smaller opposing order flows, they're going to be able to lock in some edge, lock in some money. So that's they're playing it that market makers are here every day, right? So the one big trade goes through, it can kind of push things out of whack, but then there's going to be a bunch of other little trades that,
So one last question.
And not to mention, the guy could come back, make an adjustment. So for instance, just the bottom portion, so it's the 97 spot 125, 97 spot 25, just that put spread. Someone has come in and bought for decent size, maybe like 100,000, 200,000. So is that somebody different? Is it the same guy? Again, you don't really know, but for instance, that has been an out that locals have had.
So one last
to get
one
out
last question to leave us with, Neil. Are the locals on the whole short gamma, or do they figure out a way to buy some gamma? Like, who is short the gamma? Is it the locals and the market makers, or is it the clients?
Like from this trade?
No, in general, the whole square,
or-
generally, like the whole square are there's a lot of big trades happening going through the tape on these Eurodollars, and on the whole, are the locals, like, are they the ones on the other side selling the gamma? Other clients, are there the PIMCOs of the world selling it, or is it who's short the gamma?
It goes back and forth, to be honest. I think, in general, you have locals that are mostly short gamma, but you also, there's so many like vol selling funds now, and they'll do stuff in the longer end, like the 2-year, 5-year, 10-year, right? And then there's people, and then that trickles over, and vol is cheap. So, to be honest, it's hard actually to know, especially after vol has just come off a fair amount with a Fed meeting and a payrolls this week. So, but I think in general, locals, depending on the, some locals trade long, some locals trade short. So it kind of just depends on their own thing. But paper, they usually, especially in the front end, so when they're trying to pin a strike, it's all short. They're getting short. They're short gamma. They sell the strike they think we're headed to, and they try and bury it basically, as and you can see it reflected in the common paper trade. They're not happy with necessarily just like a butterfly, right? A put butterfly now. They want to do a 1/3/2, right? So they'll or some other ratio that's taking actually even more risk and selling more.
Okay. So they're the ones, they're selling a fair bit of gamma. Anyways, we have to cut it short there. Thanks a lot, Neil. It's been a pleasure, having you on, getting your color from the Eurodollar pits, and we hope to have you again in the future.
Yeah, no problem. Thanks, guys.
Thanks, Neil. Cheers. Kev, time to move on to this week in trading history.
This is your favorite segment.
It is. And I found a great little tidbit in history. And we're circling back to the creation of KKR, Kohlberg, Kravis, and Roberts, which back on May 1st of 1976, the investment firm was designed by the three gentlemen to take public companies private in those leveraged buyouts.
It was a crazy time.
Right?
Like it was nuts. And they were at the forefront of it all.
They were at the forefront. So 3 former Bear Stearns guys that started doing this, and then they create their own firm, and they started. And that was the craze, right? Like when you think back to the movie Wall Street, or as we're going to talk about Barbarians at the Gate, but almost all of this started with KKR, right? And that during the late 80s, that was the shit.
And you know what? I think that this is kind of an interesting point, because it wouldn't surprise me at all if we're about to go into one of those stupid periods where dumb things happen and there's all sorts of takeovers that are dumb and make no sense. And like what happened today, didn't you see that there was an IPO, and it was one of the best performing IPOs since the great financial crisis? Like there's some stupid so. Yeah. One thing you have to learn in trading is that history repeats. Yeah. And so this is one of the things that I like best about This Week in Market History, is that we kind of learn these things because we should be on the lookout for them happening again. So,
for sure. So what I wanted to circle back, though, was one of the most famous takeouts was RJR Nabisco. And it's an interesting story. They made a whole movie about it, Barbarians at the Gate. And for our listeners, if you have not seen this, it's free on YouTube.
We'll put a link in the email that we send out. And Patrick brought this to my attention, and he said, I'm sure you've seen the movie. And I said, no, actually, I haven't. And I was kind of shocked when I went and looked at it. And first of all, it is cheesy. Like, there is so much cheese in this movie. I thought I had wandered into a fondue party. Like, it is just, it is kind of it was filmed in '93. I looked it up, but it's supposed to be in the '80s, and they're wearing shoulder pads, and it's so politically incorrect. And like, well, here, why don't we play this tape? Fuck you, money, which is just kind of a little taste of what sort of inappropriate behavior happens here. Roll the tape.
Whatever happens, you're safe, John. I mean, after the incredible way you've run the food division, there's no question about whoever buys it's going to keep you on. Hey, if you're not happy with the new brass, with your severance deal, plus your, 50,000 shares in Nabisco, you could walk away with $7 million, maybe more. We're not talking just fuck you money, John boy. We're talking fuck everybody money.
Fuck everybody. Right, Ross? Fuck everybody.
That's so funny, Kev. Yeah. Like, but just to give a little bit of history on RJR Nabisco. So what it was Nabisco, which was a food brand company, obviously Oreos and stuff like this, and there was R.J. Reynolds, the tobacco company.
Right. So it was a tobacco company and a food company together.
Well, and what happened was that they merged together. They were two separate companies. Back in 1985, they merged together. And they took a food company, a tobacco company, mashed it together, and then came this big event, right, where Ross Johnson, the president, got the idea from Henry Kravis, one of the KKR guys, and then Ross stole the idea from Kravis and tried to do the leverage buyout.
That's right. The biggest leverage buyout in history. And
tried to do it without him. Right.
What's really funny is the fact that it occurred because the stock wasn't going up, and they were having trouble getting the stock up. So he decided that they were waiting for this new cigarette, and this new cigarette was going to be filtered, and it was going to be much more healthy because back then they thought that...
You're going to play this clip, Ken?
Yeah, we got to play the clip. Like, come on, I went out of my way to do it. So let's go with tastes like shit, smells like a fart. Play it here.
Bottom line.
Well, of all the groups we tested, the response to Premier was just about uniform.
Mm-hmm.
They all said they tasted like shit.
Like shit?
Shit was the consensus, yes, sir.
They all said that? Nobody liked them?
Fewer than 5%.
You said you heard the results were terrific.
Well, there's nothing wrong with 5%, Ross. I'll take 5% of the smoking market any day of the week.
How much are we in for up to now?
To date?
To date, to here, to now.
Upwards of $350.
We've spent $350 million and we've come up with a turd with a tip? God almighty, Ed. We poured enough technology into this project to send a cigarette to the moon, and we come up with one that tastes like it took a dump?
We haven't even talked about the smell.
Well, what'd they say that was like? A fart?
Yep.
Oh, you're not serious. They really said that?
We've got an awful lot of fart figures, sir, yes.
Tastes like shit and smells like a fart. We got ourselves a real winner here. It's one goddamn unique advertising slogan, I'll give you that.
All right. You know what? That's classic. It's unbelievable though, but so they got into a huge bidding war. Now it wasn't the largest leveraged buyout in history because I think Dell passed it later on, like a couple decades later, when Dell and then when they brought EMC, I think it the whole reversal was the largest. But for the longest time, this RJR Nabisco bidding war that started and drove was like the shit. Like it was the biggest leveraged buyout ever. And it was unbelievable what happened. And they made a whole movie about it. Fantastic piece. But I mean, that was the time. Like if you think about Wall Street and the movie and all of that, Gordon Gekko, like this was the late 80s.
Yeah, this was it. And I contend there's more of a chance that anyone thinks that this is going to repeat. Watch for this. This is my prediction. You're going to see this sort of stupidness, like I can't even speak anymore, but this sort of craziness occur in the future. And I'm just remember, history, doesn't repeat, but it often rhymes. And watch for the next Ross Johnson in this next cycle.
All right. So let's move on. So Kev, time to move on to the WTF clip of the week, and this one truly is WTF, isn't it?
What, like I got someone kind of brought this to my attention, and it was a video of Cramer, Jim Cramer, the guy on CNBC all the time. I guess what's the Tesla guy, Elon Musk, said something bad about him, and he didn't take it so well. let's just play the tape because I think you're going to be kind of surprised by it. Let's just watch.
Elon Musk's tweet last night. Now, he called you shallow fake. Can you give me that definition of that?
Well, I don't know. I mean, it's always soul-searching when you've got Elon, late 40s man. My father, when I came home second grade, Mrs. Turoff's class, I got a B in history. And my father said that I was faking. I wasn't doing enough work. That's the last person who's basically accused me of being a shallow fake. So it's kind of Shakespearean, Oedipus-like. And I've been struggling with it because do I want to be a deep fake, meaning that I am a rigorous fake? Or a shallow fake means perhaps I have work to do in order to be less of a fake, but not just my father. And it made me feel that I was going to be tracked in the dumb class because anyone accused me of this level of lack of rigor. And I was tracked in the dumb class. I was tracked in the fourth row of the different tiers at school and didn't emerge from it until I went to Harvard. So I think that Elon is basically offering a soul-searching moment for me, and I've come back and decided that maybe he's right. You wake up in the middle of the night and you have that dream where you're fake. I've had it. So there's something deep to even his shallow.
I don't know if I want to laugh. I don't even know if I want to laugh.
I don't know if we should be laughing. This guy, he's obviously at the end of his rope. I see that he is taking this quite seriously. That Elon.
I always think he wanted Elon to be his friend.
Yeah.
And I think he's realizing that he may have gone too far and
yeah. But Patrick, you and I have our own way of dealing with things, and Cramer might have his way, and that is to get onto TV and kind of lament about it. But I think that you and I have a much better solution. We kind of take the advice of Nick. Nick from New Girl?
All right, let's see.
Okay, it's good. You treat an outside wound with rubbing alcohol, you treat an inside wound with drinking alcohol. Science.
Now that is definitely the way we deal with our problems.
That's right. Outside wound, rubbing alcohol. Inside wound, drinking alcohol. That's what he should do.
Well, I personally think that it's just that Cramer has too much dad issues.
Uh-oh! Someone has some daddy issues. Nothing could be my father from the truth. Who? You said my father. No, I didn't. How? Did not. Shabba! For me, this is a dad issue. Dad issue! Dad! Be dad! Oh. Daddy didn't love me! It seems the knighting ceremony wasn't the only time your daddy let you down.
Now that is one of the best movies. Me and my kids watch Austin Powers all the time. That's
yeah. I could just see you, Patrick. Like your kids are like 4 and 3, and you're playing Austin Powers, and your wife Mrs. Big Picture Trading. It's like going bananas.
Yeah, but my kids aren't 4 and 3 though.
No, I know, but I bet you've been playing it since they were 4 and 3.
Yeah, that's exactly it.
Well, that was truly a WTF clip that required no cutting. I don't know what the hell's going on with Cramer. I hope he's okay. That's all I can say. And don't worry about Elon. You know what? I'm sure there's other people who will kind of fix that void that your dad's left in your heart, Cramer.
All right, let's move on. Kev, It's time for the top 5 things to watch next week. But as always, before we get into the top 5 things to watch this upcoming week, we go and review what we talked about last week. And so
whoa, Patrick, wait 1 second. Before we start, I think we have to kind of give a big mea culpa for missing something.
Oh, we totally fubbed. We totally fubbed. We were like, what are we going to talk about? And of course, there's a goddamn Fed meeting and a huge jobs number, and it doesn't make our top 5 list.
Yeah, that shows. I think we were just so excited about having other things to put in the top 5 than Fed and the jobs that we missed the most important thing of the week.
Anyway.
So we just wanted to say we are aware that was not correct and that you really should have been watching both the Fed and the jobs number. But let's go through our top 5 things to watch next week. Number 5, Tesla.
Yeah, so Tesla, right? Well, that we had him do a capital raise, right? We broke down, and then they put that deal.
Yeah, and I'm actually quite surprised about it because I actually thought that when we broke down that we would be close enough to the point where his margin calls would kick in.
Yeah.
And that they would smell blood, but good for him. He's managed to do a raise into he raised it. Sorry, go ahead.
Isn't it amazing? But isn't it amazing? Like Goldman Sachs has a $200 price target on Tesla, and they are the lead on the raise at $245.
Yeah.
How are they convincing their Muppets to do all this?
It's not them. It's that crazy lady that runs that fund that has a $4,000 target on Tesla, and I'm not shitting you. She has a $4,000 target.
Catherine Wood.
I don't know what her name is. And then there's that other guy, the social guy. He's also a crazy bull. There's some people who just drink the Kool-Aid and they manage to buy this issue and clean it up. And now with that kind of overhead problem that was looming before out of the woods, we're seeing a situation where it rallies all day into the deal, and we close right back.
Yeah, but there's dilution now. So I guess you can't play the card that.
Yeah, you know what the trouble, Patrick, about that idea about there's dilution. The people that are bullish see such a large upside to this stock that it doesn't matter. It doesn't matter.
Yeah.
Like literally, they're talking.
Right.
This lady's getting on and seriously talking about $4,000 price target. Like she just drunk the Kool-Aid and she believes, and it's like it doesn't matter.
I'm almost sure you're thinking Catherine Wood.
I'm pretty sure that's her. And ARK Investments, that's the lady. So she's for her, she's thinking about this as a big play, and she's probably saying it's either 0 or it's 4,000, and got a lot of money that she can put to work, and so she's buying it, and that's causing the stock to stabilize. And now the question is, is there been enough technical damage that we're going to actually find that this, what was previously support that broke, will that be resistance on the way back up, or will we get back into that and this kind of be a reverse?
Well, you know what I'll tell you exactly is that look, there was a 1-day reaction up, but wouldn't it be something if the bulls couldn't follow through on the buying in the coming week?
Well, that would be something.
Wait,
before we go any further, I just want to kind of a big shout out to my pal Ross Gerber, who I'm sure loves me. But, I'm not very good at technical analysis. I don't know all the Fibonacci's and all that stuff. But even I know on the way down, it doesn't break resistance. It breaks support. He did this guy has got like 60,000 followers, and this guy is a huge Tesla bull, and he basically started arguing about the fact that it broke resistance and that therefore he was going to have to sell out of prudent risk management policies. I'm convinced this guy isn't real, and this is he's just an actor. He's like an LA actor playing this character, and I think that whoever's handling that account should be careful, because if they keep making mistakes like that, we're going to know he's not real.
All right,
let's move on to number 4. Trump tweets.
Well, obviously oil's been selling since then, hasn't it? And what we have is a scenario where we were overdue for a pause. Even as a technician, there's an ebb and flow in trading. After a rise, there's always a retracement, some sort of backfill after such a move. And so what I'm going to be curious about is whether or not the buyers support things here in the next few dollars. Like pulling back, $6-7 after such a huge rise would be a very normal occurrence. It would be whether or not if the buyers don't show up and don't buy the dip, then something really nasty is happening. So I actually think that watching oil in the coming week may be even more important than what in the past week, because the buyers should buy this dip if oil's going to bounce.
Well, the fact that you said it's going to be more important next week is probably correct, because we won't have it on our top 5 next week. Number 3, where does Disney stop? Let's have a look.
It did stop. We nailed it. It basically peaked out around 142 and paused. Now it's backfilling, but there's listen, a match has been lit under this thing. And this pullback might be bought on dip. So by no means am I trying to already call this an end. Very similarly, if we see that in the coming week or two that this thing holds in here and they reverse it back to 140, you never know. When there's no way I could justify this from a fundamental perspective. So this is going to be a momentum run. Will they be able to run this thing to 150, 160? What's your thinking?
Oh, I don't know. It's 1,800 million shares outstanding. I'm just looking at this. The market
it's a
cap,
250 billion market cap.
Yeah. So what did it add when it made that gap higher on the announcement of?
That's a 50+ billion for sure.
Yeah, on some streaming service.
Right. No. See, stop using fundamentals, because you can't justify. This is like a Tesla valuation thing. You're either drinking the Kool-Aid that they're going to make astronomical money from this, or this is just way overdone, right?
So you think that this is a natural pause? It wouldn't surprise me at all if we go back and we're back into that gap in the coming months. I'm not bullish. I'm not drinking the Kool-Aid.
No, all I know is that the market breadth keeps narrowing, and people and traders that are trading momentum are being drawn into fewer and fewer stocks that have that big momentum. And if Disney is one of those few, then you never know whether this thing can still have another leg higher. I think it's absurd that it's here. Dude, if it came back to 120, I would not be surprised. I mean, you're not thing, but I think it's
I think it's too big for it to have this sort of momentum. I understand your argument, but those are smaller stocks. I think this is a really big stock. I think it's going to be trouble.
Oh yeah, like Apple, Amazon, and all these other stocks have had these problems.
That's a bigger gap than most, right? That's a bigger gap than most.
Yeah.
And maybe Steve Jobs' widow will be selling this rally. Because she's one of the biggest holders. I think she's the biggest individual holder. Although I'm going through the list here and I don't see her anymore, so maybe she sold it. She's smart enough to sell it. Anyways, go on.
Anyway,
number 2, fading
the dollar.
Yeah.
Yeah. So far it's worked. Certainly there has not been a break to a higher high since last week.
I remember this because there was all the kind of technical guys that were going, we've now broken out, so we're going to explode higher. And I was
me.
Yeah, and I was
I was in that camp.
By the time these guys start buying it, you got to start selling it to them. And looks like we're there. I still contend, though, it's an uptrend. This is a little bit of a correction. You should probably be buying dips. We're headed higher. I'm not like the technicians saying if it goes higher, I'll buy it.
My God, stop.
We're headed higher.
You've pigeonholed every technical trader now to that one saying.
I managed to piss off
everyone says that.
85% of our listeners which are technical traders, and the 15% that aren't are on my camp. Anyways, semiconductors. Let's have a look at that thing.
Yeah. So, it paused, but it's been bouncing. And even Intel, which was the culprit in causing that reversal, has got that little green candle. I mean, it's now oversold. You like playing that like little mean reversion of these overshoots, and so like this thing going back to 54, 55 is not out of line. If that happens, then a double top retest on the SMH might be possible. I still contend, even though I do not believe. Remember, we have a bet on this, right?
I don't.
Oh my God! You already forgot.
Yeah, we got to write them down.
Yeah, no, I wrote it down.
What is
I
it?
wrote it down. But that the SMH in the by the end of May was going to be one of the top 5 performing sectors.
Oh, that's right. I remember that. Yeah. Okay, that's right.
Right.
Okay.
So we still have that bet. And while I don't think that SMH has to break down badly, I don't think it's going to be one of the top 5, and so I'm going to stick with that.
Okay, well, I would say, wouldn't you argue that after the Intel news that you thought was so horrific, it's actually hanging in there? You have to give me credit.
I didn't dispute that. I just don't think it's going to be a great place to put your money. I think that you're going to lose the bet.
Okay.
I'll still stand by that.
Okay,
anyway,
top
so
5 things to watch next week. Hopefully, we
Yes.
do a better job at picking things that actually matter. Okay. Well, no, this next one is actually near and dear to my heart. I know you're not a big futures trader. You actually are.
Oh my God! Of course I'm not.
Yeah,
I love for trading futures.
Really? I kind of thought you were more of an option guy and a spy guy.
Yeah, I do. I do all of that.
Yeah, but like I personally love the futures. I'd rather trade futures any day of the week. So now, what the news is, there's going to be micro E-mini futures. For the pikers of us that don't want to trade a full contract of E-minis. And one of the things you have to realize is that the S&P used to be way lower. When it was, think about it was $666 in 2008.
Yeah.
What was the contract value at that time worth? Let's just go 500 times or 50 times.
It was whatever, like $50,000, $60,000.
It was 30 grand. It was 30 grand. It was 30 grand at the lows. Okay,
right.
And now all of a sudden, a regular
it's like
E-mini,
140, 150, right?
Yeah, a regular E-mini is $29.50 times 50. It's 147 grand.
Yeah, yeah.
So they're making contracts in both. I think there's 4 of them. It's the Nasdaq, the S&P, the Dow Jones, and there's something else. I'm not really sure. Oh wait, you got it up there.
Yeah,
the Dow.
The Russell, Nasdaq, Dow.
The Russell. This is great news. This is terrific. This is awesome for anybody that's kind of wanting to trade futures but have found that the contracts are too large. And I'm super excited. I think this is a terrific development from the Chicago Mercantile Exchange. I applaud it, and everyone should be aware. Come Monday, there's going to be micro E-minis trading on those 4 indexes. Watch for them, and
I think it'll be and I'm pretty sure that because they can be cross-hedged, it's going to have good liquidity.
That's right. You're absolutely correct. It was just like when they made the E-mini versus the big one, because don't forget, the E-minis weren't the original contract. There used to be a 250 multiplier. Oh, I say used to be. I think there still is.
There still is.
The 250 multiplier on the big contract, and they went and introduced the E-minis, and they became kind of the standard. But let's just figure out what 250 times like 2950. The big ones are $737,000 a contract.
Oh, yeah.
It's an institutional size contract. This is a great development. Well done, Merck.
Yeah. And so, number 2, I wanted to talk to you about where the market's heading next.
Whoa, 1 second. That's number 4, Patrick. Okay, but it's okay.
Too much of this flying monkey stuff that I'm drinking.
Flying monkey.
It's 12 minutes to Destiny or 12 minutes to the end of the show. We gotta keep moving. But number 4, I wanted to talk to you about what's happening here in the markets, and me and you have very different views. I'm still generally in the camp. I'm not drinking the Kool-Aid that this is real, but let's be realistic. There's a point where when we're trading at all-time new highs that I'm going to have to start giving you some kudos for continuing to stick with this. But I think that we're about to get a big tell. The reaction in the days after the Fed, we weakened in the first reaction, and then it rallied right back to the highs. And so we're right up here. Is this thing got enough in the tank to just rip higher and begin new 52-week highs, or is this just a retest of the highs and going to begin at the small topping formation that brings about some form of a market correction? It's I'm curious to see. I mean, do you have a bias? I mean, obviously you have a bias, right?
Well, I have a bias, but a little part of me is worried that we're going to prairie dog this something fierce. Like, we ticked to new highs, right, on the S&P the day before the Fed?
Yeah.
And then we sold off. Now, in the next couple of days, we've rallied back up to the highs, but we haven't gone through it yet. I hope I'm correct. I hope that it keeps going, but
I don't. But anyway,
I know. But you know what? When you finally get bullish and you tell me
I'll let
because
you.
it's broken out, I'll sell it to you. You can have it then.
All right. So anyway, I think it's the thing to watch, right? I mean, I know what I want the market to do, but it's definitely in my mind one of the top 5 things to watch next week. So number 3. Did you want to say it, or you want me to? Anyway, I'll say it. Did Powell squash the steepener trade? And what was interesting was that the yield. Let me just actually pull it up over here. But the steepeners started to kick in before the Fed, and so we had first of all, you had your favorite. Your favorite trade, which is the 530s. You've been calling for that to pull back, though, right?
Right. So I haven't liked the steepener as much as everybody else has lately, and actually,
did you cover it in the last little bit?
Yeah, I don't have any of that on right now. I still think that over the next 5 to 10 years, it's going to be the trade of the decade. But now, well, that would be just like me to call something the trade of the decade and then take it off for
a swing, and then you miss it on the other side.
Exactly. That would just be
don't pull a Kevin Muir.
Okay.
Anyway, but what was interesting to me though was the 210s, because this is the big one that everyone seems to watch for the recession signal and whether there's an inversion here. And what it looked like was that in the last couple of weeks it was breaking out, and that the steepener was being set in motion, and that got squashed on the Fed. And at least on a short-term basis. What's your feeling here?
So I think this is actually a really important point to delve into. All you guys that are economic bears got super excited about the kind of the dovish words that were cooed by the Fed over the past couple months.
Okay.
And as usual, Wall Street has taken those words and gone too far with them. I just don't buy that the Fed is anywhere close to ready to cut rates. And that is what the market is starting to price in, or had priced in. And that is why when Powell came out and said that inflation might be, what was the word he used? Transitory.
Right.
They freaked out because they said, holy shit, maybe he's not as dovish as I thought he was. And maybe they're not about to lower rates like we thought. And that is why I think we're seeing the yield curve flatten. And,
well, fair enough. And you see that but you also see that, like, you look at here's the 2-year yield, right? The 2-year bond, and you can see that it pulled right back. The 2-year yield spiked, but you're basically, this is where I'll agree with you that because Neil did a great job earlier talking about the fact that everybody in the Eurodollar markets was crowded to the one side. Everyone was convinced that the cycle's turn. And I think the Fed just gave everyone a wake up call that maybe it's not as imminent.
It's not just listen. This is where I disagree with you. It's not just the Eurodollar markets; it's everywhere. Mm-hmm. And this is ultimately why I'm bullish U.S. dollars. Why I think the stock market could head higher. I think that everyone has convinced themselves that the economy is about to roll over. The Fed is about to chase the market, the yield curve down, and that things are just going to go to hell in a handbasket. And I just don't think that it's as bad as everyone believes. And I saw that Scott Minerd, I don't know how to say it, from Guggenheim. He's a lot smarter than me. He's definitely a lot tougher than me. You seen that guy? He looks like a football linebacker.
Yeah.
But he I hope he doesn't listen. He's going to come beat me up. But the reality is that he thinks that the Fed's next move is a hike, not a cut.
I don't subscribe to that at all. Okay. I'm in the consensus. I'll admit it, and you can shame me for that. But
no. 1 second. No need to shame you. I think that
the market will do it.
This is a good bet. This is a good bet. I think this is a good one. We got to do this one. And this one will eventually, the next Fed move on the Fed funds, up or down, I think I'll take up. You take down.
Really?
Yeah.
Done. But are we going to, tell me we're going to do something more than a Duke and Duke bet on this?
Yeah, we got to do more than a Duke and Duke. Let's do something that's fun.
We're going to have Lena start writing these things down.
We should.
Because
I know what we'll do. I can't afford the steak dinners if I lose all these ones. But what we're going to do is we're going to do a burger joint at your favorite place.
Okay, sounds
okay.
Like
so
plan, yeah.
Burger joint bet. There you go. Burger joint bet.
All right, on the next Fed move.
Yep.
That sounds like a plan. All right. So with that said, I don't think that after listening to Aidan earlier, I personally have to think that you're going to be very wrong. It's
he's a smart guy, that Aidan. He really is.
Yeah, and
he probably take all. You two get along like like a house on fire. You guys are exactly the same, right?
Well, no, he's a little bit smarter than me, but that's
right.
Okay.
Well, I'll vouch for that. Number 2, let's go have a look.
Inflation, and I mean, we could almost have another bet on this one too, right? Like I think that this is one of our bigger points of contention in general between the two of us, right?
Yeah.
And certainly, didn't you say that Ross Gerber had a say in this as well?
Can you pull up his latest tweet? Now, I'm not sure, again, that Ross Gerber is a real guy and that it could just be somebody running this account. But he says, there is no inflation coming. Powell acts like he saw the White Walkers. Personally, I don't really understand that tweet, whatever. But the fact that Ross Gerber's in your camp made me feel really warm and fuzzy inside, Patrick.
Oh, my God. Okay. So, but for why is it that we put it on our top 5? I mean, we've talked about inflation with the headline on Bloomberg and stuff, but it really is that next week, starting on Thursday, is the U.S. PPI, and then we have the CPI numbers coming out on Friday, right. And obviously. All eyes are going to be on this because is the inflation number going to come in hot? Clearly there's a strong influence on commodity trends, and commodity prices have not been strong, right? And I mean, maybe oil.
Well, oil has, energy has, and energy is a huge component. The question is the rest of it, But it's okay. Ross Gerber says it'll be okay, so you're fine. Don't worry about it, Patrick.
I am with Ross on this one. All right, so number 1, we were going to talk about Buffett. He had the shareholder meeting, and also I wanted to just kind of put in there his him buying Amazon.
Yeah.
Right.
So you know who actually asked me if I was going was our good buddy Cuppy. Remember Cuppy?
Yeah.
Yeah, like Sting, right? The great trade Scorpio tankers. He's a true value guy, so he worships at the altar of Buffett, and he's going to the. Oh my God! Did you dial Sting? You better dial this before we do anything more.
It's unbelievable.
Yeah,
it's running. This is the Huddle effect.
It has nothing to do with all the years of work that Cuppy put into it. It's only he got on our show, right?
He got onto our show. That's all it is, right? Our listeners get the benefit, and now that they got the, or actually no, our listeners still haven't heard the stock picks from Aidan, so they'll get that later on in the show.
You're absolutely right. But we got to get Cuppy back on. But interestingly enough, he is at the Warren Buffett or the Berkshire Hathaway kind of pilgrimage to Omaha. Have you ever gone, Patrick? Do you?
No, I have not. No, I do not.
Yeah.
No,
Well, yeah.
no.
You know what? I think that
that's too much. That's too much value investing for me.
That's right. I think that they would hear you're a technical analyst and they would like stop you at the door. I think they would actually.
Yeah, they
check
wouldn't
your
even let me in.
That's right. They would be like, they have a very, very famous rule about nobody that's a CMT. Is that what you are, a CMT?
Yeah.
A CMT. They'd be like, no CMTs are allowed. I think that's what they would say. No, actually, they're very nice people. I'm sure they would take you as long as you.
Anyway,
have Cherry Coke.
I love cherry Coke. No, just kidding. But I don't actually. But Amazon, though, Buffett announced that he's putting on a position in Amazon. I mean, is his market timing skill? Either he's going to look like a rock. Like, okay, let me just stop for a second and really rewind. Okay, Warren Buffett. Can we agree he's been around for a while? I mean,
yeah, that's right.
Has he been around for at least the last decade? He's been around.
Yeah,
right?
no, but what's the big handle on his age? It's still an 8, isn't it? Like I think it's still an 8.
Yeah, he's not in his 90s,
but it's close to a 9, right? Like
right.
Yeah.
And so Warren Buffett back in 2009 clearly did not see value in Amazon at $40.
Yeah,
he didn't see in 2014-15 value in Amazon at $300 a share. But he lets this thing go up multiple thousandfold, or not thousandfold, but like tenfold plus. And now he's a buyer near 2000.
Yeah. Okay, so to be fair to Warren, it's not him buying it. It's one of his lieutenants. And he says he was an idiot for not buying the stock before. Obviously.
Well, I'm an idiot for not having bought it before either. Like,
That's
I mean,
right.
I could join that camp.
Right, but it's not him. The point is, it's not him. He's not buying Amazon. It's whoever this fellow is. They don't even list him in the article in terms of who it is. But he's trying to pass it on to the next generation, because let's face it, he hasn't got another 2 decades of investing ahead of him. And actually, here's a question for you. I have a buddy that this is a little like morbid, but he thinks the stock market will top on the day that Warren passes away. Now, we don't want to wish anybody ill will. So, like, I hope Warren goes another couple of decades and he's picking stocks at 110 or 120 years old.
Oh.
But I do think this is an interesting kind of concept that he has, that this will be this, that somehow, I don't really get where he's coming from, but he's insistent that this will be the top in this kind of bull market, and that you should watch for it. And anyways,
but he's in good health. I mean, he pounds back at cherry Coke every day.
Exactly my style in terms of what he buys. But speaking of that, let's just talk a little bit about Oxy. He's buying. He's giving not Canadian Occidental. It's no longer Canadian
Occidental Petroleum,
but it's Occidental Petroleum. He's given them a blank check to go out and buy Anadarko. It was actually super interesting. Did you follow that, Patrick?
No, I didn't. But we'll look up this chart here. So, I mean, the stock's now at $58. I mean, look at being an energy investor sucks. Like in the last year, like owning these, like ConocoPhillips, any of these things, like it's been a tough go, eh?
Yeah, Patrick, it's been ugly in the energy square. It just doesn't seem to be able to get off the mat. And I actually have a kind of theory about this, and it kind of dovetails with our idea about the tobacco stocks that we were talking about in This Week in Market History. Way back when the tobacco stocks were a terrible investment, nobody wanted to own them. You were kind of viewed as like a dirty investor by buying them, and yet they ended up being some of the best performing stocks going forward. I really actually agree. I think that Jared Dillian came up with this theory that the oil stocks have become the tobacco stocks of this next kind of cycle, and that we're going to see them get cheaper and cheaper, and that eventually they're going to hit a point where they actually outperform the rest of the market because they become so cheap. And I don't know if we're at that point yet, and if we have to see them actually get sued like the tobacco stocks did. But I think that's the reason that the oil stocks can't get off the mat, is the fact that investors just don't want to be seen owning like a dirty stock. And I don't know
if it's about dirty or not, but I'll tell you this much, that like some of the Canadian energies are just selling at ridiculously cheap prices, but nobody's they're not being bid up. I mean, there's value guys coming in there buying it, and they're just losing money and watching these things bleed. At some point, it's going to be a no-brainer to own these. But I said at some point it was a no-brainer to own gold miners back in 2015,
right.
And I'm still singing the same tune
So
4 years
Patrick,
later.
I'll leave it to you to decide when we have no brain. On that note, let's just call.
All right, let's move on. All right, so
Okay.
you have a parting words of wisdom from George Soros.
So I love George Soros, second greatest investor ever that's ever lived. Number one is Stanley Druckenmiller, and I'm going to read his quote, and then actually it gets a little funnier from there. I'm only rich because I know when I'm wrong. I basically have survived by recognizing my mistakes. Okay, so that's terrific. I completely agree with him. Not being stubborn is one of the biggest parts of trading. Right. But then I kind of went on to this next part of his quote that I think is kind of funny. I very often used to get backaches due to the fact that I was wrong. Whenever you are wrong, you have to fight or take flight. When I make the decision, the backache goes away. So, like, does that mean that trading is as simple as, like, wondering if you have a backache? Like, I've been doing this all wrong. Like, that's what basically that's what I took from
and it's what's amazing is I've had a sore back for honestly the last week.
There you go.
And
I know why, Patrick. Patrick, stop right there. I know why. Because you're fighting the market.
Oh my God!
You're fighting the market. You're
I've been dying to figure out how to get rid of this backache.
Well, there you go. Just cover it, buddy. George would tell you that's all you need to do. Anyways,
awesome.
So that's some parting wisdom from George Soros. Anyways,
right.
It's been a great, it's great, chatting with you, Patrick. It's a lot of fun. Don't forget to stick around for Aidan from Pavilion Global Markets, which is a terrific after-hours conversation. Also, if you can't handle a couple hours of the Market Huddle, which completely understand, do not blame anyone who can't handle that. Make sure you go check out the Market Huddle segments where you can get the different parts of the huddle one by one and listen to just the parts you want to listen to.
Absolutely. And so if you want to follow Kevin and myself on Twitter, first of all, you can follow the Market Huddle itself. So the Twitter handle's at the Market Huddle. You can follow Kevin at Kevin Muir and myself at Patrick Ceresna on Twitter. And certainly, please share the show with anyone who you think could be a potential huddler. Share the huddle with everybody. And otherwise, is there any final things, Kev?
No, just share the huddle so that they can get the Huddle Puddle. There you go.
Anyway, so listen, stick around, everyone. We got more Aidan coming up after the show. Thanks, everyone.
Thanks.
All right, so joining us here in the after hours, we're welcome back, Aidan. So, Aidan, first of all, I really enjoyed your presentation during the main session because it's music to my ears. I love confirmation bias when I have a view and someone just gives a different argument, making the same conclusions, which is fantastic. And I'm certain Kevin is going to have to at some point jump in here and give his counter argument if he has one. But
I was just floored. I'm still staring at the charts, wondering how I'm going to kind of actually refute facts like that.
There's going to be a bigger huddle puddle.
That's right, the huddle puddle. That's what it is.
So Aidan, what I wanted to do is jump in here and circle back with you because you, in your chart deck, you actually had shared some views on the U.S. dollar. And so far you're on a roll. So I just would love to hear your thoughts on the dollar and where you think the U.S. dollar is heading next.
Yeah, so we've been of the view for a few months now that the dollar was heading stronger, and I've been articulating this view to clients and to prospects, and I've got a lot of pushback saying the Fed's becoming more dovish, and that's going to weigh on the dollar. But I actually see this just continued shortage of dollars, which again is impacting China, it's impacting other EMs. And until the Fed goes back, it doesn't matter how dovish the Fed sounds, until they go back to expanding the size of their balance sheet, dollars are getting more scarce every day. And that's just putting more upward pressure on the dollar, particularly as global growth continues to slow, because typically what you see is when growth is slowing, that's when people or countries or companies delever. Well, so there's this massive dollar shortage out there among emerging markets who have levered up in dollars since 2013, taking advantage of that massive carry trade as U.S. rates fell, who now all of a sudden are facing declining trade volumes, as I'd shown, so they're not growing FX reserves, and global growth is starting to weaken, so now their central banks are looking at cutting rates, which makes this carry trade less effective. But let's go on to what we can actually demonstrate here in the slides I brought today. So on this page, what you're seeing is the dollar, and different ways of looking at it. So versus the majors, and then on a trade-weighted basis. So the U.S. dollars rallied against the Aussie and CAD because those more industrial-driven economies or value economies, as I'd call them, they're more cyclical and they've run into trouble lately, right? So that explains the weakness we've seen in those currencies. I think what's more interesting is what you see in with the dollar yen cross and the euro dollar cross, which are the bigger components of the DXY index. So if you go to the next page, let's look at the yen first, which is about 14% of the DXY index. So here what we're seeing is, we've seen this rebound lately in Japanese portfolio flows back into U.S. assets, right? So that number was, falling for much of the last 2 years, in large part because the FX hedged pickup for Japanese investors was negative. So that's kind of a mouthful there. So by and large, most of the large institutional investors, the insurance companies in Japan, they're not allowed to take much FX risk. They have to hedge about 70% of their FX exposure. However, you look at these dynamics that have played out in Japan where there's no more yield to really have there, and the BOJ is taking these the JGBs off their balance sheets as it continues to do QE, and you've started to see these large firms now start to go unhedged into U.S. assets. And you can see this on the very next page. So this next page, there's 3 lines here. So the red line, I'll start at the bottom, is just the simple dollar-yen exchange rate. The dark blue line is the return that you get if you're a Japanese investor investing in U.S. treasuries on a currency hedged basis. So this would be U.S. 10-year yield minus the 10-year JGB, and then you subtract the interbank rates and then the cross-currency basis. So that's your FX hedged pickup. So although, ostensibly the 2.5, 2.6% yield that you were getting on U.S. treasuries was super appealing, on a currency hedged basis, it was actually pretty negative. And that's why over the last few years, you didn't really see much inflows into U.S. treasuries. However, there seems to be this point on the U.S. curve when the 10-year gets to 3%, it's like catnip for foreign investors. Like they just can't refuse it, and resist it, I should say, and they just go in. And so what you're seeing in this chart is previously when the hedging costs, when the hedging pickup was becoming expensive, i.e. when you got no hedged return, the dollar started to weaken against the yen. But recently we've actually seen that start to not be true, where the hedged pickup on U.S. treasuries is negative 34 basis points, but we're seeing more of these inflows into U.S. assets from the Japanese. So that's the yen story. I think what might be a little bit more interesting and what actually points to this incipient dollar shortages is what you start to see on the next slide when it comes to the euro. So similar chart here. Now the euro is about 60% on a standalone basis of the DXY, but you throw in the euro-related currencies and it's significantly higher than that. So. Right. Over the last few years, it's been these interest rate differentials and these growth differentials that have driven the euro-dollar exchange rate. And you can see here, what I'm showing you is the euro-dollar exchange rate inverted on the right axis versus the 10-year yield pickup that you get if you were a if you were a European investor in U.S. Treasuries. So by and large, these interest rate differentials appear to be driving the currency. Then all of a sudden we get this breakdown in September of last year where the yield pickup just, gets more negative, but we actually see the dollar just rally against the euro kind of in contrast to what you'd typically expect. One of the reasons for this, or the main reason, is if you go to the next slide. So this is the currency unhedged pickup that you get if you're a European investor. So this here is US 10-year minus the German 10-year Bund. So from that breakdown point in September until December, it looks like European investors are starting to go unhedged into U.S. Treasury yields. As U.S. yields kind of rise, they get more appealing. Then that breaks down in January of this year, and it looks like the currency dynamics are starting to be driven by something else. So what's driving the euro-dollar exchange rate now? And that will take us to the last slide in the deck, or one of them, which is dollar financing. So this chart shows you, I've kind of zoomed in here. So this is where the second breakdown occurs in the beginning of 2019. So this is the euro-dollar exchange rate versus the U.S. Treasury repo index. So as we've seen, the Fed so the problem is in the U.S. is that you have a bunch of these financial sector regulations that were kind of like a hodgepodge, and combined with, so you had, Dodd-Frank, and then you had money market mutual fund rules, and then now you have the balance sheet reduction, and this is all creating a dollar shortage. The reason being is there's some bank liquidity ratios, like, the acronym is RLAP, and you can just Google that. But there are these bank liquidity and capital ratios, some of which are calculated and looked at on a monthly or quarterly basis, but some of them are calculated intraday. So banks have to show some liquidity, they have to meet some liquidity guidelines intraday. And those liquidity or capital ratios, they can't be met with treasuries. They can only be met with reserves, right? So as the Federal Reserve winds down its balance sheet, it sucks out excess reserves from the system, creating the shortage. That is why what we're seeing here is banks are less willing to use balance sheet, especially at the end of quarters. You see these repo spikes pick up. And so, you can see the dollar shortage in the U.S. in the U.S. financial system among, some very popular metrics that have come out lately, such as, the effective funds rate versus IOER. Well, if you're seeing a dollar shortage in the U.S., imagine what the dollar shortage is like outside of the U.S. for banks that don't have access to the Fed's liquidity window, right? And if you look at what we've seen over the last few months, the ECB has been clamoring at the Fed's foreign central bank swap line in order to get some of this dollar financing. And so as this dollar shortage just continues to become more intense or more acute, the cost of financing picks up externally. You get more borrowing. They dump the euros for the dollars to satisfy either their requirements or their own liquidity shortages. And then the euro recovers after they then cover that euro short that they have. But as this goes on, as this gets more acute, what you're seeing here is the euro just continues to make lower and lower highs versus the dollar, and these repo spikes just continue to become more acute. So again, as long as the Fed is not expanding the size of its balance sheet, excess reserves are dwindling. They're getting tighter, which is putting pressure on banks' liquidity ratios, some of which need to be calculated intraday. On top of that, you have the U.S. Treasury, which is running a $1.6 trillion deficit. Well, what does that mean? That means they're pushing out USTs to the rest of the world or to investors and sucking in dollars, right? So that's another a way dollars are getting shorter, or dollars are getting tighter. And then on top of that, you have the Fed's wind down of their MBS portfolio. And because the Fed doesn't target duration, right? So mortgage-backed securities, there's negative convexity to them. Effectively, that just means that there's this like prepayment risk as yields fall. So if you're a private sector investor, you would, and you invest in bonds, you would want a stable duration. You'd get that by investing by using interest rate swaps to hedge that duration risk. The Fed doesn't do that. The Fed doesn't target duration. So effectively, they've been suppressing interest rate volatility by just not bidding up the implied vol on these interest rate products. As they push more of this interest rate risk, duration risk into the private sector is going to use these swaps to hedge the duration. That's going to drive up interest rate risk, interest rate volatility. And because everything's priced off the yield curve, it creates volatility across assets. Right? So then if the Fed really wants to wind down its MBS portion of its portfolio, it has to buy an increasing proportion of treasuries to suppress the vol. So you have these three things here that are at work that are just sucking out dollars from the global financial system, making dollars tighter.
Okay, so Aidan, I'm going to jump in here because what I want to ask you, I've heard a number of people try to build the argument that we are on the verge of seeing another Shanghai Accord here to kind of rein this whole thing in. But you can't just decide to have one. There has to be a counterbalance where the liquidity is driven on the other side. I mean, what's the feasibility in your mind that they'll be able to suppress the dollar in some way, or is this just inevitable that there's simply a stronger or higher dollar is going to happen no matter what?
Well, all else being equal, the pressure is for the dollar to get stronger. I guess the inherent question that you're really posing is, well, against what, if they're going to devalue the dollar, against what do they devalue it against, right? And as you've seen them, it looks like over the past few years, each central bank has gone through its kind of period of having a strong currency, which has just decimated economic growth in those economies. So it's tough from a cross basis, it's tough to see what they'd actually devalue it against. And so it's problematic. You would say, well, okay, maybe they should devalue it against, for example, there's been rumors that they'll just devalue it versus gold. Maybe. But it's because of this dollar shortage that you've seen and the increase of dollar-denominated debt, that's just ballooned globally since 2013. If you devalue your currency against the dollar, then you make debt service extremely more onerous for your corporates and for the financial systems of your country.
Right.
Okay, I'm going to jump in here, Patrick. So first of all, Aidan, some of the pushback that I get when I make your argument about the U.S. dollar obligations, meaning like the amount that U.S. dollar emerging market borrowings that have happened, is the fact that we're looking at it in absolute terms and we should be looking at it as a percentage of GDP. And although it might seem like we're at record highs in terms of in total dollars, as a percentage of the economy, it's actually not as bad as everyone thinks. So you talked about, what was the number for how much 800 billion of Chinese kind of U.S. dollar denominated debt, and that was a much bigger deal kind of 5 or 10 years ago when the economy was, probably half the size. What would be your response?
I'd actually argue that it's more meaningful now because in 4 or 5 years ago, China was building foreign exchange reserves. China was running a current account surplus. Chinese corporates who have this debt were increasing earnings and profits, right? That they were generating an FX currency that they could use. Now that's no longer the case. So but as a proportion of GDP, perhaps it's somewhat lower, but the serviceability has gone down.
Okay. So then the next thing I noticed is that you mentioned the Fed selling or winding down their MBS, or at least being less of that market, and the effect that it has on Treasury volatility. And this is something that's kind of near and dear to my heart, and I've actually talked about and written about this kind of prospect, the fact that when the Fed bought MBS, they withdrew volatility from the market. They were, in essence, I completely agree. They don't hedge their MBSs and they just let them float. So therefore, there was no kind of change in their duration. They just let when the duration of their portfolio changed, they just lived with it. But that's not the case when you deal with private sector owning those MBSs. As the duration changes, they actually change their delta changes and they hedge it in essence. What do you think is a natural, does that mean that you would be a buyer of Treasury vol? Like, do you think it's going to be enough to actually move and cause us to, the move is sitting, which is the kind of implied volatility index of the Treasuries, right? Like, it's sitting at lows, and I've been sitting here wondering, when are we ever going to see volatility on the fixed income market, and it just hasn't come. Do you think it's coming, and do you think that the Fed, pitching their MBS or winding down their MBS is going to be one of the driving factors?
I think that definitely exacerbates what's going on there. I don't know if that's going to be the kind of main factor that's going to do it. I think it's just a combination of events that are, winding down dollar liquidity and doing this. It's tough to actually show what would drive this Treasury vol higher, because you're seeing the term premium so suppressed. There's just this natural buyer. I actually think what ends up happening is, if you get this growth slowdown in the U.S. develop over the next few quarters, and I think that could do it, because you just get, it's almost like over the last few days, not the last two, but prior to that, the S&P was actually rising, and you were seeing the VIX go up, right? And I think that is something that is maybe something that could happen, is if you saw either growth slow meaningfully, if you saw some sort of stagflation like pressure in the U.S. economy, which is not my base case, but if you saw that, then I think that would do it as well.
So if growth slows, do you think the curve inverts? Do you think the Fed is going to be quick enough on in terms of easing to actually get out, or at least keep up with the curve? Or do you find that do you think it'll be one of those situations where the whole curve kind of anticipates it? And in fact, we're almost you could make the argument that that's what's happening now, is that the market is definitely more bearish on the economy than the Fed is. And if they end up being correct, and that the Fed is wrong, and that the economy rolls over, do you think that we're going to get a situation where the curve inverts? And could we see an inversion of 2s10s go to minus 25 or minus 50, which has happened in the past?
Yeah. I don't know if you get that far. I think one of the ways the Fed is trying to step in and really minimize this is they're trying to make QE market driven, right? So they have this plan called the Standing Repo Facility, and effectively what they're trying to do is allow banks to just show up anytime they want at the Fed window and exchange treasuries for dollars or for excess reserves. And so if they actually put that in place, then one of the views is that would actually kind of minimize this volatility and this inversion, because there would it would just be cash being exchanged for treasuries, and that would do it. I do think that my view is that I heard
though, Aidan, is that the same scenario? I heard that if a bank ever though utilized that window, that would be a sign that they're in some sort of crisis, and that would actually be like a death sentence for that bank. Would a bank actually even use that facility?
Yeah, good question. If they were making it, the ECB just, bored from the swap window. Yeah, that's a good question. So I think it depends on how it gets done. If it was a big, reputational, if it ended up being implemented in a way that would be a big reputational risk, then they wouldn't. And then I think what you would see is just hoarding of treasuries, and you get the curve invert. Does it go to 20 basis points or 50 basis points? I don't really know, but I would think that you are going to see. So my view is that you're going to see the Fed become dovish sooner rather than later. So I think the Fed is akin to this. It's seeing it with the effective funds versus IOER that just doesn't make any sense. So I actually think they go back to QE sooner rather than later, and they kind of avoid this, and then they just juice the system again.
Well, there you go, Patrick. He's Aidan's in your camp.
Oh, I this is a wonderful interview. I'm enjoying every minute of this. This is great. Aidan, do you have any views on the equity markets or anything else in terms of? Well, first of all, are you generally bullish Treasury bonds in this environment?
Yeah, so I'm kind of, the way I think about it is if I think the Fed's going to do so if the Fed goes back to more stimulative policies within a context of slow growth, slow economic growth, then I think pockets of the growth stocks can continue to do well. Long duration, including treasuries, will continue to do well. But I also think that you can get some alpha in more of the housing-related sectors as well, like the lumber firms, which they've fallen along with lumber prices. But if you look at about in 2017, 50% of home purchases were by millennials, right? The problem facing the home builders is that they're constrained by rising construction costs, both material and wages. So even if housing, comes back to a certain extent, they're crimped. But I think if yields, as yields fall, and now we're starting to see mortgage applications come back, then the inputs into the housing market, i.e. lumber, some of the lumber firms, they can maybe outperform this. So I guess I would kind of take a step back and say, look, I think there's 3 R stars for the economy. I don't think there's 1 R star. There's an equilibrium rate for households. I think there's a slightly higher equilibrium rate for corporates, and then a higher equilibrium rate for the financial sector. Heading into December, it seemed like the Fed was just hiking because they wanted to tame financial sector imbalances, right? And that was the key message that they started to hearken back to. So I think we've increased rates above the R star, the equilibrium rate that is appropriate for households, and then you saw what happened, right? Home sales started to fall, durable goods orders started to fall, consumption started to weaken. They didn't stop there. They kept go on.
Just to circle back there, because a lot of our listeners like stock ideas and things like this. So when you're talking lumber stocks, are you talking like WY and RYN? Like, are we going into?
No, Aidan's a Canadian, so he's going to give me Canadian tree stocks, aren't you?
So there's a lumber ETF called Wood, and I think that does well. The other thing is in the U.S., look at the performance of the utilities, consumer staples, real estate versus the 10-year yield. They've just continued to outperform. So I like some of these defensive sectors. I like lumber, and then pockets of the quality growth stocks in the U.S. because they're going to benefit from liquidity.
Interesting, because like when you look at this Wood ETF or subsequently let's take a look at RYN. Like these things have obviously got killed throughout 2018. They seem to have at least bottomed in the last kind of 4 or 5 months, and they're all rolling up. So you think that these have potential to continue to benefit from this environment, right?
Yeah, I do, especially if yields continue to remain depressed, because then mortgage rates become more affordable. You get the new home buyers coming back in.
So, Aidan, I thought that was a terrific comment about, I'm bullish on the home builders, but you've given me something to think about in terms of maybe I shouldn't buy the home builders and maybe I should just be buying the tree stocks. But one of the things that, Pat, you were talking about the 3 R stars. You're talking about for the consumer. I'm guessing the next one is for the kind of general corporate economy. And then what's the third?
The third is the financial sector, right? And so for that, you could almost look at the high yield spreads, which is, I think, what they were going after. They were trying to. So my view is the Fed oversees the formal banking sector, but they don't oversee the shadow banking sector, i.e. CLOs, right? And so if you look at how the way the CLO market works here is that maturity and credit transformation. We were taking, junk and turning it into mostly AAA securities that yield LIBOR plus 175. So I think what the Fed was, so as long as LIBOR plus 175 is lower than whatever the high yield yield is, that just incentivizes this shadow banking activity to continue, which the Fed wants to crack down on because that's where the financial sector imbalances are. It's about 1.6 trillion in the U.S. So I think what they were trying to do is raise front-end rates. So as you raise front-end rates, LIBOR plus 175 ends up increasing, and you get a flattening of this CLO curve. And then it's not accretive to issue the CLOs anymore, and you've killed them, but you've pulled credit back to the formal banking sector that you oversee and that you can put in place regulations to make sure it's running properly. So I would say those are the 3 R stars. And if you want to look at an indication that you're past R star for corporates, the one chart I like is it's in the bigger deck. It's on page 39, but what it is, it's the interest coverage ratio for U.S. firms, and I exclude financials and resources because it kind of biases the sample. But what you're seeing is that we're back. Interest coverage has fallen from about 8% in 2015 to now, 8 times in 2015 to about 5 times now. So we're back to 2007 levels on debt service coverage, even though interest rates are less than half of what they were in 2007, right? In 2007, rates were at 5.25. Today we're at 250, and firms are having problems, covering their
That's
their
because
debt
they've
service.
all geared up, right? They
all, the GE problem, right? GE is kind of the poster child for what I think had happened here. You look at the Russell, where 36% of firms are zombies.
Okay.
You look at, so there's just
So
all of these.
Let's talk junk. Let's talk junk because this is the J&K, actually. I think, or do you prefer the HYG? Anyway, the point being here, that one and the same. So you've got the high yields all seeming to react on the Fed. I mean, they all kind of seen this gap. I mean, that's an overreaction. It's just noise, really, until we see a bigger trend develop. But I mean, what a rebound! It's almost like when you're looking at the credit spreads, they've narrowed right back, basically like all the concerns the market was having in late 2018, were just brushed it off and brought those credit spreads right in. I mean, what's your thinking here? Is this just it's nonsense for them to be rallying to this magnitude? Is there still big risk?
No, I think it's quite rational. So if you break it down by sector, what you actually see is the energy spreads have remained slightly wider than other sectors. That's because 40% of zombie firms in the U.S. are in the energy sector. But look, if you think that the U.S. is going to avoid a recession, but the Fed's going to be forced to come back to QE and more stimulative policy because of this dollar shortage, then go long duration, go long. It makes sense for these high yield spreads to be coming in.
So do you think they'll be able to avoid a recession though?
Currently, I do, and so the reason I say that is what has been driving growth, and again, you'll see the story really play out in the bigger chart deck. But it has been the energy sector that has been a major contributor to U.S. GDP growth over the last few years, more so than the traditional metrics that we've seen. So historically, it's been residential fixed investment that's, for example, led the manufacturing PMI that's led U.S. real GDP growth. That really broke down in 2017, 2018 as yields just continued to rise and residential fixed investment slowed. Instead, what was driving PMIs was the oil and gas sector of the U.S. economy. And you can see this. U.S. PMIs, manufacturing PMIs versus oil and gas extraction as a percentage of GDP became highly correlated in 2016 when you saw the ISM really pick up. If you look at the Fed surveys, that activity has continued, although it looks like it's starting to slow somewhat as oil prices, have really come off their highs. But, unless you see a crash in oil prices, that's likely to continue, and that will support growth. The other place that will support growth in the U.S., if yields just continue to fall, is going to be the housing sector. right? Because you'll get the buyers start to come in, refinance mortgages, and so that can be of some support for growth. So I think the main issue for the Fed is avoiding, a crisis somewhere that makes the growth slow down, turns the slowdown in growth into a recession. But,
right.
I don't want to kind of sit here on the fence and say I don't see a recession. I see a slowdown in growth that could become a recession if the Fed waits too long to become dovish and you see crises kind of emerge. Because as growth slows, towards 1.8, 1.6%, it will become more vulnerable to a recession, although that's not my basis.
So, Aidan, I'm going to jump in. It's Kevin here. So I know it's getting late. It's Friday night, and you're in the Belle Provence, and you're going to want to get out to the bar because you're not allowed to drink with us. But I'm going to leave you with one final question here. So you mentioned the 3 R-stars, and actually I think that was a truly unique way of looking at the economy. I'm going to go home and think about this because I think it's just a wonderful way of describing it. And I actually think there's a lot of wisdom in that idea that there's 3 different levels upon which the different sectors of the economy take off. One of the worries that I have is that as the Fed gets easier, due to the fact that the consumer part is slowing down and they've reacting to that, the financial part, which I believe probably has a higher R-star than everybody else, is going to take off again. And how do you reconcile the fact that what if the Fed in their pause, and I agree with you that the Fed was trying to slow down the financial part of the economy during that last 2018, we're a long way from neutral. I don't think they were worried about inflation. I think they were worried about financial conditions. But what if in this pause, they inflate in financial conditions again, and we take off, and they're no longer have kind of the, let's just say the gravitas to actually go and nobody respects them anymore enough to actually stop the financial part of it taking off? Like, what is your worry on that side? Do you have a worry there, or do you think that's just nonsense from a crazy bull like me?
No, I look. I think that is the big problem, and that is what the Fed wants to crack down on. Is this just improper lending, right? Because this is how cycles end all the time. After recession, central bank get easy, the economy recovers, but then you get pockets of excesses. I think the issue here is that if the Fed is kind of trapped because they almost need to become more stimulative to shore up the dollar market and well, really because of this dry up of dollar liquidity. But in doing so, they exacerbate the financial sector imbalances. So I think that's clearly a risk. I think one thing you may be able to see is some, if they change the rules around how excess reserves are, how that system works. Around what type of activity the shadow banks can do, and really I think it comes down to because the credit flows through the banking sector, which then pushes it due to the shadow banking sector. So if you were to put in place rules around CLO warehousing by banks, which you've seen, for example, some banks have got out of the business, but some banks are still in it. If there were just more rules around what banks could do, then I think that would help stem those concerns. That's probably very unlikely. So to answer your question succinctly, yes, I'm worried that the Fed is in a very tough spot where they have to ease to save the economy and to, stop this acute dollar shortage. But in doing so, they create problems further out down the road. But what else is new with central banks and governments?
Well, that's a terrific way to end it. Aidan, it's been a pleasure having you on. You've given us tons to think about. I just want to thank you again for sharing your chart book. It's outstanding. And just for those that are listening that want to get the chart book, don't forget to sign up for the weekly email. And if you miss it on this week, just shoot the Market Huddle, shoot Patrick or I an email. We'll make sure we send it off. Before we leave you, Aidan, we'll give you one last chance to tell us where people can find you and remind people what you do for a living and that they should be kind of phoning you because these sorts of insights are truly unique and something to think about, and more people should be calling you up.
Sure, thanks. So I am head of global macro strategy and research at Pavilion Global Markets in Montreal. My email is on the front of the presentation deck. It's agarrib, AGARRIB, at paviliongm.com. Or you can find me on Twitter at Aidan Garrib.
Thanks again, Aidan.
Thank you.
Thanks,
guys.
Aidan.
Thanks.
All right. So, Lena, anything you wanted to say, or do you want to just cut it?
No. Lena's got to say something. For sure.
To what you were saying about back pain and making decisions, and Patrick, you mentioned about your lower back pain. I was just looking up an article, and so physical pain can be related to emotional stress, and it says chronic money stress often leads to lower back pain, neck pain, and shoulder pain. And this is on Forbes, by the way. It's not just
there you go.
Blog or anything.
Who would have known that? Hey, by the way, Patrick, I don't know if you know, but Lena tweeted us, or not tweeted us, but sent us a note while we were chatting, and she said Elon Musk tweeted that Kramer is a stimulation. He's not real.
Simulation, you mean?
Yeah, simulation. Yeah. Oh, did I say stimulation?
I heard you say stimulation.
Those could be two very different things. So.
Kramer is a stimulation. No,
although it would have been funnier.
I don't think Kramer is a stimulation for anyone. I will take the other side of that trade. But actually, it's interesting you say that, Lena, that he's a simulation, because I think Ross Gerber is the simulation, not Kramer. Yeah, like I really do.
Well,
I think.
Yeah.
I don't think he's real. I really don't.
All right. Well, listen, we got to wrap this up because I'm going to make a huddle puddle in here in just a moment.
I've been holding it the
you know
whole
what?
time.
If Ross Gerber is listening and you want to come on our show and show us that you are real, anytime, buddy. Open invitation. Come on our show and prove to me that you're real, and then Patrick will school you on the difference between resistance and support.